It is time now for Pro Picks, Dan Wong's highest conviction ideas. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, now it is time for Pro Picks, Stan Wong's high conviction ideas. And your first idea is Dollarama. And I'm going to immediately take you to task, Mr. Valuation. You don't like to buy expensive stocks. And your first recommendation is Dollarama. How can we not call it an expensive stock?
Well, I would say that in the beginning of the show, I said that I like companies that are in industries with very limited competition. And Dollarama doesn't really have a crowd. They really don't have a lot of competition in the mass merchant dollar store space. There's very few. Yes, Dollar Tree is up in Canada, but on a very limited fashion. The valuation for some of these names, you're going to pay a bit of a premium because they really have no competition and they have a great runway for growth and they have great pricing power. You are paying about 39 times forward earnings for Dollarama, but you're getting about a 14-15% long-term growth rate forecasted going forward. They've grown about 19% over the last 5 years per year. I think that with the Canadian economy looking a little bit uncertain, household debt being at near all-time highs, if not all-time highs today, the cumulative effects of inflation since the pandemic, I think you're seeing a downshift in the type of spending that's happening with Canadian consumers. People are cutting discretionary expenses, prioritizing essentials, and really looking more for value. One thing that I found out about Dollarama is that they have 60% of their sales is in private label products, which is obviously very profitable for them and beneficial. They're looking to grow to 2,000 stores by 2031. That playbook will continue to perform well for them, just given the fact that they've done so well with the stores that they're at today, which I think is about 1,500 stores. And then you've got Dollar City in Latin America, which is, I think, a bit of a hidden growth engine.
And they, being Canadian, they don't have to deal maybe with the tariff anxiety on Chinese importers to the extent that its U.S. peers do.
Not so much. And I think that, as you know, there's really nothing for a dollar at Dollarama or any other dollar store.
Dollarama, yeah.
And they've pushed up to the $5 mark, which will expand their revenues and their profits as well.
It's such a beautiful stock. Just to it's at an all-time high, and normally it can be tricky to buy things at all-time highs, but going back to 2010, it has only had 1 year where it's been down, and that was 2018. So that is quite a track record of easily plus 20% growth. Most of the time it's plus 25% growth.
And one of the things to look at is since they IPO'd back in 2009, the stock price on a total return basis is up 5,540%. The TSX is up 262%. So it's a comparison of nearly 30% annualized returns versus 8.6% from the TSX. So clearly the technical chart, don't even need to mention it's a series of higher highs and higher lows, trending higher. And as long as that competition remains limited, Dollarama will do very, very well.
Your second pick, less of a household name, is Marcato Libre. And this, is it a retail play in Latin America?
Yeah, you can think of it. A lot of people think of it as the Amazon of Latin America, but I kind of think of it as the Amazon, the PayPal, and the Shopify of Latin America because they have a heavy presence in the fintech space, which is actually their higher growth area. They're obviously in e-commerce as well. The shares are trading at 47 times earnings with a 35% expected long-term earnings growth rate, which is phenomenal. You're looking at 1.3 times PEG ratio, which is fairly cheap for this type of growth rate. Its historical 5-year growth rate has been 50% a year. So really, it's a digital powerhouse. So think of it as Amazon without the cloud, basically, but also add on PayPal and Shopify. The fintech division, which is Mercado Pago, which is Pago stands for, represents payment in Spanish. that's really moving more so into that full-scale digital banking space. Profitability is really scaling with the business as well. And there's really not a lot of competitors, which is another reason why I like this name.
Another stock that's at an all-time high, that's trading around 50 times earnings. Why does that make sense to you?
Because the growth rate is so phenomenal. You're looking at 35% growth rate with almost no competition in the fintech space and very little competition in the e-commerce space.
And I think there's something to be said for buying stocks at all-time highs that are making highs in a nervous market, right? One of the things I've learned, through doing this show is to not be afraid of that relative strength. I think there's a temptation to look, I'm such a sucker for these United Health stories where they drop 50% because I think I'm going to have an edge. But I find in my portfolio, the winners are the ones that have been the winners.
Yeah, and I'm a big believer in highs, bring more highs, basically. And if these companies can prove themselves in times like we've had these volatile times, that tells me something. That tells me that there's a lot of strength in the numbers behind these companies. So I think that it's great to try and pick some of these companies that are down 50% or 40%. And we will do that. But we like to do that with companies that still have these great earnings growth rates. And Liberation Day and those few weeks in which things drop 20%, 30%, that's, like a kid in a candy store.
Speaking of which, Netflix certainly got hit on that Liberation Day, but is now trading at an all-time high. It's not technically the Magnificent Seven, but boy, it has been a magnificent stock. Took a while to get back above its 2021 peak. But then when it did, it's like, where does this thing stop?
I think Netflix is running very hot on all cylinders. The shares are trading at 45 times forward earnings, which is expensive by itself, but you're looking at a 25% long-term growth rate expected. Its historical EPS growth rate is about 23%. So its forward earnings is similar to its historical earnings. This new ad tier business is adding consumers in which they didn't have before at a lower cost and lower revenue base. So they're increasing their subscribers. The password sharing, we're all guilty of it. That's working well for them as well. That crackdown on password sharing. And you're seeing a lot of content in different regions, which is attracting local subscribers. So really the drive is to more international subscribers.
The thing, Netflix for a while seemed like a tariff immune stock. And then there was that kind of Trump post on Truth Social that he wants to tariff things that are made outside of the US, like films that are made outside of the US. And then it was kind of a poof. And then we don't really know, how would that be enforced? How does that affect a Netflix? How confident should investors be that Netflix is tariff proof?
Well, I think the market has really told us that they were worried for a day and now we're at all-time highs. So I don't think there's a lot of concern with it. I don't really see our earnings growth numbers change very much. I think we look to the positives on the stock, again, with the ad tier opening up new consumers, with the password sharing crackdown, with their ability to raise prices and nobody blinks an eye, because I think that their pricing, it's really inelastic demand. People are just willing to pay that extra $1, extra $2 every couple of years, and they're fine with that. And then this move into something that we didn't expect 5-10 years ago, which is the evolution of streaming, is getting into live events, whether it be boxing, whether it be WWE sports entertainment, or it could be NFL on Christmas Day. These are new frontier type of areas in which we never thought, like before, where we thought about cable TV. Well, where else are you going to watch a live sporting event? Well, now you can watch it on Netflix.
Why Netflix over Disney? Disney is benefiting from a re-rating recently, and it's so much cheaper. They've also got streaming, and Disney is not optional in my household.
Sure, yeah. I have Netflix in our household. I have Disney in our household, but I think that Netflix really appeals to a much, much wider audience. And I think they appeal to a lot of local audiences in international markets, whereas Disney has their content and they're building some new content, but then they've pulled back in what type of new content they want to do because it just costs too much. Netflix has really been able to put more money into new content, which is driving more subscribers. again, with Disney, you've got other areas to concern with as well, which is their ESPN and their networks and so forth, which is, clearly on a bit of a flat line or decline. And who knows what happens with theme parks, because it really depends on how strong the economy is going forward. So Disney, you've got other moving parts to it. Netflix, you've got the straight streaming. I think that it's proven that Netflix is not just a COVID winner, it's an all-time winner. And that's what we're seeing today with all-time highs.
Stan, thank you so much. Great insights as always.
Thanks for having me.